So a very good morning, afternoon, as well. It could be some good evening to everyone on this webinar. As Japa mentioned, my name is Darren. I'm the Business Development Director based out of Singapore. And over the next half an hour, I will be sharing our point of view as to why it is so vital to redefine customer experience in the area of transaction banking. And the agenda will be as follows. I'll first set up the context of what corporate transaction banking is all about. This is to make sure that everyone is on alignment as to where the focus of today's session will be. I will then touch on the importance of digital customer experience and what is the value that banks will derive out of that exercise. And finally, I will just put on my forward-looking hat and share with everyone what lies ahead in corporate transaction banking that we should be aware of and how we should prepare for that future when it comes. Now, when we talk about corporate transaction banking, the focus here is on commercial activities that take place in the physical world. So we're talking about payment, settlement, and reconciliation. It is done by entities and typically with multiple users. And one of the phrases that I will always use in my engagement with our customers is this: retail banking, one bank account, one user. Corporate transaction banking, one bank account, multiple users. So I think that's where the difference lies in for this particular vertical within the banking sector. And again, just to re-emphasize, I'm talking about the physical world, because we all know that there is a burgeoning and rising e-commerce space that's out there right now, selling of digital goods. The focus is not there because we're talking about the overwhelming majority that still deals with a physical product, raw materials, transferring their raw materials into output that needs to be distributed to retailers. So that is the world that I'm focusing on. In the areas of corporate, and where entities are concerned, typically they can be described in these four different categories. Of course, we have the mom and pop single proprietor. They typically will use their personal CASA account for financial transactions. Then the small business owners and the mid-size typically are clubbed together in the term what we call SMEs. They range from simple banking needs for working capital right up to much more complex needs in the areas of complex supply chains. And finally, the large companies typically will refer to those that higher up in the tens, in the thousands and above. They will typically be multinational in nature, having operations in different jurisdictions. For the purpose of today's session, we will be very much focused on small and medium-sized enterprises. And you may be asking, why am I focusing on that area? Well, if you were to take a look across Asia Pacific today, and using the numbers from last year, and taking into account that it takes in all the dramatic experiences of the COVID pandemic that's happening out there as we speak, we still see that SMEs form a huge percentage in terms of participation in economic activities. Case in point, both in North Asia and in ASEAN, both export and import numbers are in trillions, of which 99%, up to 99% of all enterprises operating in those regions are SMEs. And if you were to take South Asia and Oceania, numbers are not that far off from an exporter and importing activities, but still, again, more than 99% of those enterprises are SMEs. So it goes to show there is a sufficient market size out there for corporate banks, transaction banks, to be able to provide services for this important and vital sector, because keep in mind that there are uh, transaction banking services for the larger MNCs out there, but the SMEs with their unique needs is a very captive market that corporate bankers should not avoid. And that is the reason why I feel that this will be a good market for us to go into. Some of the reasons why SME market proves to be an attractive proposition is that it provides a stable, low-cost funding for bank. I mean, what they're asking for is a business operating account, a savings account, and in some cases, a merchant account where debit and credit cards are issued both at the corporate level or virtually to each of their employees, where you will be able to control their spending when they go for their business activities. So again, the needs are less complex than a large company, and that will allow the bank to be able to design their services productively and be able to deliver that efficiently on the digital channel. More on that later in my later part of my deck. And we also have to keep in mind what is the one and only priority in most SMEs out there is to make sure that their working capital and secured and the funding gap is kept as low as possible. So what do we mean by a funding gap? For those who are new to this what you see in front of you is a typical transaction user journey where you sell something on credit based off raw materials that you have to purchase from an SME perspective. You need to hire staff to be able to sell that product into the market, and what further decisions on buying more raw materials or trying to hire more people to sell, that is based on the cash flow at the end of their financial period. And this is where you see from an SME perspective when cash is needed and when cash flows comes in. This is what we define as a funding gap. That's where the working capital comes in. And from there on, how banks will be able to react to that will be products such as instant payments, overdrafts, as well as line of credit. This will be there to be able to help address some of the gaps that will appear from time to time where cash payments are not received timely for the SME to be able to respond further as part of their commercial activity. Other areas for SMEs in this regard is that when they go over into expansion mode, they'll then be able to get term loans from the bank, and typically they are fixed in nature. And then from there on, they will be able to go into new markets or try to grow their export volume. And all this, by the way, are able for the banks to be able to deliver with service fees attached to it. And from there, you will be able to find that as you scale up the number of SMEs that you service through the digital channel, the fees will prove to be a very good business case for the bank to proceed in this particular vertical. Now, as the smaller ones move over to more mid-sized companies, their needs will be considerably different, of course. Working capital will still be there, but then they will move into more in the areas of transaction banking, where treasury will come in as part of the consideration from a funding perspective. Then as they go into more markets outside of their normal jurisdiction, typically outside of their country, trade and foreign exchange will come into it as well. And of course, advisory services typically led by the RMs. So over here, the banking needs will be different as well, much more complex, much more advisory focused, and typically will involve the FX team making sure that the correct hedging strategy is being applied, where you're able to do trading over different countries. And this is the kind of services which will then allow the banks again to be able to charge a different variety of fees, both at a flat rate or at a percentage of that transaction, again delivered over the digital channel. Now, I kept saying about the digital channel, and this is where I'll be refocusing the session today on what we call the digital customer experience. because in most cases, the SMEs, through a lot of the research and a lot of the market feedback that goes into the banks today, especially to corporate bankers around in Asia, is that look, their access to finance is extremely curtailed and difficult. And and from the bank's point of view, these SMEs typically will represent higher default risk, the lack of financial transparency because the balance sheet is still new, and there's a lack of collateral to be able to be pledged. And that again proves to be a bridge too far for some of the banks to extend those financing opportunities to SMEs. And as some of the SMEs wants to grow their export volumes, they start to realize that trade finance is one of the biggest hurdles for them to grow that volume per se and really take advantage of their global supply chains. And finally, uh, we all know that liquidity and cash flow is critical for SMEs, and that's where faster payment settlement sometimes may be a pipe dream for some, because if there is inaccurate transaction details supplied by their counterparties, or the wrong beneficiary account number has been entered as part of the transaction process, sent without validation through the corresponding banking network, the unwinding process typically will take the number of days of settlement, extending it over a longer period of time, and this will again affect the liquidity and cash position of SMEs. So these are some of the biggest hurdles facing SMEs today, and that's where banks will be trying to find out, hey, how am I able to address some of these challenges faced by my SME customers? Because in today's fintech dominated environment right now, there are fintechs going into the market and really trying to bring that kind of financing to these SMEs. Typically, what this means is that they bypass the banks, they go straight into engaging with the SMEs. They take into account that what's your cash flow position. At this moment, they will extend a short-term to mid-term loan, okay? And they will be able to use advanced analytics as well as credit scoring based on alternative data sources to be able to lower their NPL percentage to a low single digit. So again, they are very active in the market, very aggressive in some of the segments whom today are underserved by the corporate bankers who are still thinking how best to service this segment. And typically, when we talk about trade finance, and especially in the COVID environment that we have all of us are facing right now, uh, because of the short tenor and the typically a lower yield, and of course the risky cross-border nature, and of course the most important thing is it has to be is totally dependent on the corresponding network. We do see that the volume of trade finance has gone down considerably, and that will again have a great impact for some of those SMEs seeking to grow themselves out of the pandemic. And for some of those SMEs who have trade financing facilities, they also see that the currency risk exposure has increased as the dollar appreciates against the local currency, as we are seeing today. And that by itself further compress the trade finance opportunities for these SMEs. So what do we do? As banks, uh, what banks need to do is to really take a step back and refocus their attention on how to service these segments, the SME segments, in a more efficient and productive way. And what I'm going to show to everyone is a framework around digital customer experience for the transaction banking sector. And these are the eight buckets that I'm showing to you right now, ranging from managing your funding costs all the way of leveraging data to build new products. And of course, I'll be giving you some examples of the strategies for each of those buckets in front of you. So from a funding cost perspective, all of us know that when SMEs do their trade, be it domestic trade, and for some who are actually performing external trade by trading to overseas countries, the funding opportunities is very stable. And by opening different savings account, and of course extending those loans from this liquidity that comes in. This allows the bank to keep its funding costs low over time, and this is where we are seeing a very some of the banks out in Asia today taking considerable interest in doing onboarding of customers through digital channels. So for some of us who are in transaction banking, we do know that to onboard customers, we are talking about us making sure that the customer comes into the branch, giving us the necessary documents so that an account is open at over the counter, typically using the core banking service. So some of the banks out there are trying to move away from that, trying to keep this as branchless as possible by going through a digital user journey for onboarding. In the area of digital channel, it allows banks to be able to move away what I call traditional segmentation models, where they look at the corporate vertical through the lens of industry, through the lens of sector. Yes, no doubt that is important because some of those sectors have their unique characteristics which point to a basket of services that fits to the sector. But it's also equally important to be able to make sure that whatever services you bring to that vertical, it matches the persona of the users that are engaging with those services on the digital channel. So for example, if you are going to engage with the C level, the managing director, the CEO, their needs from a digital channel perspective is considerably different from a finance manager or a finance executive whose needs focuses on day-to-day financing decisions, which do not need to be in the same lens as the C level when they take a much more holistic long-term view. So persona targeting is now achievable on the digital channel, and corporate bankers today should take advantage of that to make sure that their services are targeted to it. And in the areas of trade finance, which I mentioned earlier, uh, the focus is on how to move that away from the perception that is low yield, that it is short tenured and of high risk. How do we move away from that is for us to consider tapping on solutions that mitigate that risk so that bankers are able to focus on growing the scale of generating more trade financing. So one of that ways of removing that risk is to attach yourself to the Swift GPI network, whereby you'll be able to do STP tracking of all LC statuses, and because messages are delivered over ISO 20022, which offers a much more richer set of data to be able to perform all those financial transactions, corporates will be able to track from end to end what is the status of the payment and when is expected to arrive. And this also taps into an established network which most corporate bankers are very familiar with, the SwiftNet network. And from there on, you'll be able to present using this network the ability to give your corporate customers a level of certainty, a level of predictability as to when the payment will reach them. And the network is growing today. It started a couple of years back. We're talking about more than 1,500 banks are using this right now. It's doing about 150 currencies over more than 2,200 jurisdictions today. So I think the scale and breadth is growing. It's growing rapidly, and it will be a good opportunity for most banks to tap on that network, again, to lower the risk and to be able to let the banks focus on growing the scale of trade financing. Now, in the areas of UX and UI, where design is concerned, we have to look beyond the design part and focus on the silo systems that is presently operating in some corporate banks out there. So there could be a system that's just focusing on trade finance. There could be a system focusing on corporate card issuance, each one of them got their own front end layer. They will require some of their existing customers to log in at different systems. We're going to do away with all that, because in today's day and age, we're talking about focusing the attention of the users on a single user journey. And that's where integration comes in, to make sure that all those different systems, there are different ways of uniquely identifying that user from those systems perspective. They need to be aligned into one single unique ID, so that at any point in time, the customer is able to know at what stage they are they in from a relationship with their corporate bank. And this typically will require a digital design thinking mindset, and this will require the banks to be able to collaborate closely with both their business users as well as their UX designers, to be able to come up with the right frame of engagement with those corporate and users. Now, that is the front part where we're talking about where engagement with the customers come in. At the other end of the spectrum, that's where you need to make sure, from a corporate banker, the ability to mitigate your risk, the ability to make sure that at any point in the life journey with the customer, you stay on point in the same lane as the regulators. You should be able to make sure that you're compliant with the different jurisdictions that you operate in. And this is where it is vital to focus the attention on making sure KYC is a constant journey, and it doesn't stop at the point of onboarding the customer. As you can see in front of you, not only you do onboarding, but in the areas of product origination, in terms of regular maintenance of the account, and finally at the point of offboarding the corporate user. These different stages represent the life journey of a corporate entity. And at different stages of their engagement with the bank needs to make sure, where do these corporate entities stand at any point in time. Only at that level of verification on a near real-time basis, banks will then be able to make sure they stay on point on compliance, and avoid incurring hefty fines from some of the regulators if any of the KYC falls through the cracks. In the areas of branches, again, we're going to move away quite rapidly right now from being a cost center to a revenue center. We're starting to see that happening in a lot of the branches around in Asia. We have seen that happening in Singapore, Malaysia, even in Philippines and in Vietnam. They are reinventing how the bank branch is going to be like. It goes beyond tellers, but more of an advisory position. And typically from a corporate banking setting, this represents one of the most tangible way to engage with your customers on a face-to-face level, which is extremely vital for any business transaction to take place sometimes. Okay, and that's where bank branches post-pandemic will be a different proposition from what we see today. Now, as we move over to the technology side, because those delivery of services, the customer experiences that we derive out of there comes that kind of delivery will require a very agile and flexible technology stack, which typically you can build on your own, but in most cases around in Asia, they will buy from established vendors. The stack typically, as you can see in front of you, focuses on different layers of engagement, where services today are actually developed from a component perspective, tied in with a lot of the domestic payment switches, as well as third parties through an open API relationship. And finally, as you go down to the layer part, most of the orchestration with the core banking systems as well, the databases, is done as microservices. So this keeps the performance of the entire digital customers experience to be a light one. It is not taxing from an investment perspective, as well as from a technology perspective. And as and when regulation allows it, you're able to lift and shift this architecture onto the cloud. That will also gives you a much more bigger margin in terms from operational costs to service the SME vertical. So all this that I've shared with you so far, the glue that ties everything together is what we call data. Okay, and data, as you can see, from a commercial business bank to a SME or to whatever corporate entity that's out there, these are typically delivered over a digital corporate banking solution. And within that solution itself, there will be the likes of payment, trade finance, inbound bill, as well as your cash concentration, all pooling. Each of these transactions will generate the transaction data, and from that data, it will go off into a data lake where it will be picked up by an analytical tool like the Tableau or the SAPs. From there on, they will be able to build data models of that data lake and then design solutions based off that data model. And from there on, you'll be able to see a very nice cycle of data that comes from this loop that you see in front of you. And as long as you're able to get more and more SMEs into this data journey that you see in front of you, the incremental addition of data into the data lake will only make the product development much more refined, much more attractive from a delivery proposition. And that is the reason why having that digital channel is extremely critical in that regard. I will now focus on a use case based off what I shared with you from that framework. So this use case focuses on a palm oil player. Is both a manufacturer and a trader. It typically holds inventory for 60 days, and they face considerable challenges in the market. First, of course, they are exposed to the underlying commodity pricing, extremely volatile because it's a dynamic commodity. They are operating in different jurisdictions, typically in countries whereby land is cheap and abundant, but this also means that it's extremely fragmented from an operations perspective. And because they operate in different jurisdictions, they will then be exposed to different forex risk, and that adds on the complexity of what exposure that they are in at any point in time. And in operating in those markets where they are representing there are representatives who act as intermediaries in those foreign countries buying on behalf of others. From there on, you as a palm oil player would then have to assess who these intermediaries are, what is my counterparty risk. And from there, you then, when you do your transactions, what are the local tax implications? What are the currency fluctuations that takes place within those countries? And that will lead on to the last part as to if I were to perform my activities in those countries, what is the regulatory parameters that I need to follow through to make sure I stay on the right side of the law. So these are 6 common challenges faced by SME that operates in this kind of use case that you see in front of you. So what most corporate bankers should do from our point of view is to do mapping of those pain points that I painted out, as you can see right in front of you, and address those pain points to what a bank can do today. And typically what they can do today comes as follows. For example, we can tight their working capital facility and make sure that any transaction limits is tied to underlying palm oil prices. When you have that limit tied to the palm oil prices, you will then be able to mitigate the level of risk in overextending what you as a palm trading may do from time to time. And as you move down the list, you realize that FX, cross-border hedging, be able to manage your cash pool, taking full advantage of the trade solutions to create your LCs, as well as uh, reaching out to the wider banking, the wider community operating on the transaction banking side to find out what are the very specific advisory services that that the bank's able to advise its SME. And this will be linked over to different components in a typical corporate banking solution, whether it's limits management, multi-currency payments, your hedging from a FX perspective, making sure that all your different entities operating in different countries are all aligned into one single organization group, as well as taking full advantage of trade finance that's out there. So this is how a typical mapping is done. And once the mapping is done with what the bank can offer, at from there on, you then overlay that to what channel it should be delivered and what is the customer experience of that delivery to the corporate entity. Okay, I now end up with what lies ahead for corporate transaction banking. Uh, there are four areas that most transaction banking bankers should focus on. First and foremost, of course, is blockchain. Uh, which is a unique case because blockchain has been around for a number of years. It's not massively mainstream right now, but a lot of banks are experimenting in the areas of trusted contracts, hopefully removing paperwork because of the non-fungible audit trail. But it's still not mainstream yet. Trade finance is still prevalent as the gold standard for doing trade, cross-border trade as we speak. In areas of CBDC or central bank digital currency, which of course is a response to the cryptos that is operating out there right now. If this comes to speed and growth in the scale that we are seeing today, it will probably reach a stage whereby it will allow real-time cross-border payments and potentially removing the need for swift transaction messages. And if that is achievable at the level of scale or in certain regions where transactions takes place, like in Asia Pacific, you're looking potentially further reduction in transaction costs because it removes the need of correspondent banking. For corporate banking, it is one of the unique risk faced in this vertical in the banking side is to find out who is the ultimate business owner or the UBO. Because of the nature of how corporate entities are formed, sometimes they be multi-jurisdictional in nature or multi-layer in terms of hiding who is the ultimate business owner. That's where AML and KYC may hit roadblocks because they have certain limitations and dependencies on the databases they are working with. So this is where working with partners like in the areas of AI and ML that constantly try to dig a bit deeper, creating the level of relationship across multi jurisdictions. From there on, you will be able to find out the if you were be extending banking facilities to this UBO, what will be the risk exposure that you will have. And finally, as more and more governments digitize and offer more services to their end users, both at an individual as well as a corporate level, we are beginning to see that more national identity registries are coming up and delivered through digital. In Singapore, we all are familiar with SingPass and CopPass. In Pakistan, there's Nadra. In India, there's the other hard network as well. This offers a unique identifier to be able to see who this particular user is. And once you have a name, you have a number, you will then be able to track exactly what is the person's full identity audit trail. And because you will have that audit trail in place, you then be able to help them to open a digital account. That's where inclusion comes in. And that's where the digital government will be able to disperse sometimes their fiscal benefits directly without going through the checks way. And for my last slide, before I hand over to Ashwarya, the whole context of digital customer experience for transaction banking, the whole context resides on the premise that there will be a digital layer that engages with the corporate entity. Uh, and that's where you're able to take what is available at core banking and the different systems that support it, moving up to the business services layer before engaging with your with the corporate entities to whatever front end that's out there.